Welcome to the Greater Central Florida Multifamily Investor Group, where we focus on investing where it makes sense. Hello, everybody. Welcome to the Greater Central Florida Multifamily Investors Group meeting, where we focus on investing where it makes sense. I'm your host, Ismael Reyes. The goal of this group is to learn from and help each other do multifamily deals with a focus on Greater Central Florida, be that properties here or investment partners that are here. So that's the focus, right? We've got folks here that invest elsewhere, but they've connected somehow in Florida and been able to make that transition. And so it's just great to have an opportunity to do this virtually still. I know I've been toying with the idea of going back to, or for me, it would be starting a live show, but I kind of feel like I'm going to miss a lot of the folks that are here from elsewhere. So I don't know. We'll see. At some point, maybe I'll convert to a hybrid if I can make that work. But I definitely want to give folks that are not able to drive it to get somewhere specifically to be able to get this content, which I think is the key. And so we're here to talk about real estate syndications today. Essentially, and I'm not going to give up the show here at all, but it's really the pooling of capital and resources to acquire a piece of real estate. It's how I've been able to partner with others for acquisitions as large as $18 million. Our last closing was $18 million in a property in Tallahassee at the end of last year, raising just under $6 million. And we're still working on raising a little bit for that one to close it off. But just an extremely large amount of effort that goes into these things. But when you break it down and you're able to bring in other people, you really can get it done. And it's so much better than, for me anyway, burning light, just trying to go after one single family at a time, which is actually more risky when you think about it. And in fact, my first two syndications were as a passive investor, and I was overseas working in a job where, in the military, where I really didn't have, control of my time as much as I would like. And so it was kind of nice to sit there and, and not have to worry about who's taking care of the property, who's overseeing the property manager. But enough about that, enough about, me specifically, but do please have questions today. Make sure you bring them out. We've got an expert here to talk to us about this. And in fact, it's somebody who who's working a deal for us right now as we speak. So definitely excited to hear what he has to say. I'm going to turn this over to securities attorney Mauricio J. He's going to speak on syndications and more specifically talk a little bit about their structure, discuss how to legally raise capital. I was just on a call not too long ago where we were, I had to caution people about, hey, be careful what you're doing here because it can get you in trouble if you get a little bit too aggressive on how you do this. And he'll talk through that with us, especially as it relates to, how we employ social media marketing into these. He's going to talk potentially about some changes that the SEC is churning on that will make it a little bit harder to qualify as an accredited investor. We'll see where that is. It's certainly it seems like it's kind of taking it away from some folks that have earned it, but we'll see where that goes. And then he'll talk a little bit about some advanced syndication techniques. And this is going to be straight Q&A. So he'll start off with some discussion, make sure that everybody on the show has a good basis, or a starting point, and then we'll go into a Q&A after that. So I think that's going to be sort of how we get about this business. And as I mentioned before, we do have, our guest speaker does have a time commitment. So we're going to kick this off quickly. We're going to do introductions of new members of the show after we do the speaking engagement. And then those that want to stick around and network, we're going to be here to do some of that and really go over, talk to some of the folks, maybe some questions that didn't come up, or, as we have discussions, maybe there'll be some additional questions that we could answer. So what I'd like to do now is formally introduce Mauricio J. Rauld. I'm just excited to have him. He is the founder and CEO of Premier Law Group, a premier boutique securities law firm. And he's got over 20 years of experience and is a nationally recognized expert on private placements. He works with elite entrepreneurs who seek to increase and protect their wealth through syndications. Mauricio specializes in Reg D exempt offerings and educates investors like us from around the world on how to navigate the complex world of securities laws. Known for taking complex matters and making them simple to understand, that's critical for me. Mauricio is sometimes jokingly referred to as one of the few lawyers who actually speaks English. So I'm going to leave it there, Mauricio. I'm turning it over to you, and feel free to add to your introduction. I know I could have said a lot more, but I think it's important for us to just get this show on the road.
Well, no, that's great, Ismael. Thanks so much for that introduction. Thanks so much for inviting me, and I'm super excited to be here today. Thanks for everyone to, spend a better part of a Monday. For a lot of you guys, it's Monday night. I'm on the West Coast. It's only about 5 o'clock here, but thanks so much. Looking forward to, providing as much value as you can. I was telling Ismael before, I always feel like, the way to maximize value to whoever is listening is to really do a Q&A, because that way, instead of, me talking about something that I think is important, let's talk about what you guys think is important or what you guys are concerned about. So I'd really love for this to be as much of an interactive Q&A as possible. I am going to have, maybe we can call these some opening remarks just to get some juices flowing and stuff. But I would encourage you guys to put questions in the chat. And then maybe after, 10, 15, 20 minutes, however long this thing takes for me to babble for a little bit, and then open it up to questions, and we can talk about what's really important to you guys. I think this was meant to be a little bit more of an advanced thing. So I do want to cover some of the basics just to make sure, number one, kind of as a reminder, reminders are always good. And you may have heard it from different people. So it's always good to sort of listen to the way I kind of position things, and then just make sure everybody's on the same page before we kind of get into some of the stuff that's a little bit more advanced, and advanced structures or kind of new, really kind of exciting and cool things that have happened over the last, 12 to 18 months that I think if you're thinking about or are raising capital, can definitely help you in that endeavor. So as Ismael mentioned, I'm a syndication attorney is what I would call myself, but really what that means is I'm a securities attorney, an SEC lawyer, because, even though you guys will be, if somebody's raising capital, typically you're raising money to buy real estate. A lot of people say, well, why is the SEC even involved in this? I'm just buying a piece of property. Why is the SEC bothering me? Why do I have to comply with securities laws? And the reason we comply with securities laws is because the definition of a security under the SEC is extremely broad, right? So it doesn't just include the usual stuff that you think of as a security, like, stocks and bonds and mutual funds, but basically anytime you take money from passive investors where the returns are generated by your efforts. Every time you take money from passive investors where the returns, all the activity and the returns are generated by your efforts, you are selling securities. That's why SEC is involved. That's why you need a securities lawyer. That's what I'm for. And my sole job is to make sure that you're raising capital in full compliance with both federal and state securities laws. So once you understand that you're in the business of selling securities, that you're taking money from passive investors and you're doing all the work, then as I semi-joke, there's really only three things that you've got to really kind of conceptualize and understand. Number one is you must either register that security with the SEC, which sounds awful and we don't want to do that. Or number two, we find an exemption to that registration, which is the ideal world. Or three, it's illegal. Those are kind of your three. You register, find an exemption, or it's illegal. As I mentioned, we don't want to register just because that's basically going public. So we don't want to spend the time or the energy or the money to go put a full-on, public offering with the SEC. And quite frankly, if you're in the business of real estate, you're in contract, right? You've got 45, 60 days to close, maybe 90 if you're lucky. You don't have a year to 2 years to go through the registration process, right? So it's not really even realistically, even if you wanted to do it. But the last thing you want to do is register your security. Then obviously you don't want to do anything illegal, which isn't just Bernie Madoff stuff, which is what most people think of. Obviously, if you're going to be doing Ponzi schemes and defrauding investors, that's going to be illegal. But anything that's non-compliant, right? And we'll talk about some of those things. So for example, using social media and advertising a deal when you're not supposed to, or maybe paying capital raisers, or maybe accepting accredited investors. Ismael, you mentioned accredited investors, maybe accepting those when you're not supposed to. So there are non-compliant things, but really the bread and butter for everyone, and especially your securities attorneys, is what exemption are we going to look for? Because that's the key. We're not going to register. So what's the exemption? And fortunately, there's a couple of exemptions that are really by far the most popular ones. And those are the ones you've probably heard of. And I'm not going to get too technical. It's probably as technical as I'm going to get, but Rule 506B, for example, is the most popular exemption. You've probably heard that exemption before, 506B. And 506C is the other popular exemption. And probably between those two, you're looking at 95, 98% of all the exemptions out there, right? So that's why I typically focus on those two. There are a couple of other exemptions that people use, but for purposes today, let's just focus on 506B and 506C. And just as a quick summary, and hopefully you guys have heard of this before, and if not, I'm happy to answer questions to kind of fill in some of the gaps. But 506B is the one that, of the two, by the way, 90% of those people use 506B and only 10% use 506C. So 506B is hands down the most common exemption. And the reason for that is, number one, you can raise an unlimited amount of money. So that's great. Number two, you can take certain non-accredited investors. You can actually take up to 35 non-accredited investors in your deal, so long as they're sophisticated, although that's not a super high barrier, but they've got to be sophisticated. But you get 35 non-accredited, which means if you've got friends and family and, co-workers or people that you've known, which is typically what you're going to sell to when you're first starting, then this is a great exemption, which is why a lot of first-time syndicators use 506B. The main limitation is really you cannot advertise or generally solicit it. So you're not allowed to go on a podcast or something like this and pitch your deal. You can't go on Facebook or Instagram or do any of that stuff. This is meant to be a private thing for just your friends and family and people that you have what we call pre-existing relationships, really is what we're looking for. And so that's 506B. Then about 7 years ago, we came up with 506C, which essentially is exactly the same, except it allows you to advertise. It was kind of like a little twist to the whole thing. You were not allowed to advertise in the past. And now the rule came and said, hey, look, we want to encourage, this is in 2012, when, right after the recession. So we want to encourage people to raise money. So let's allow them to advertise, but then let's just limit them to accredited investors only. So 506C is very similar to 506B. It just allows you to advertise, but it limits you to accredited investors only. And you do have an obligation to verify those investors. You must take what's called reasonable steps to verify that they are accredited. And that's it. I mean, my job then is to make sure that, number one, we select the right exemption for you, whether it's B or C or whatever other exemption, and then making sure that we're following those rules, because there are safe harbors, meaning if we follow these rules, we're kind of assured that we're in compliance. So we don't have to worry about any guesswork or anything like that, which is why, again, they're very popular. And I will bring up one other point, because it may come up in some of the other questions as well. One of the reasons, the last reason I'm going to point out that they're so popular is that they preempt state law, meaning you don't have to worry about each and every state if you use one of these exemptions. So if you do a 506B or a C, and you have investors from 10 different states, I don't have to worry about hiring an attorney in the state of Florida, because I have Florida investors, and an attorney in California, an attorney in Texas, and all these different attorneys, which, number one, you got to talk to a bunch of lawyers, so that's a drag. Number two, it's going to cost you a lot of money. And number three, you've got to somehow structure your syndication so that it fits into the statutes of all those, of all those things. So that's a nightmare. So we're always, preemption is paramount importance to us. So B and C are preempt state law. We don't really have to worry about the states, other than we always worry about the anti-fraud provision. So we don't want to make sure, obviously if you're out there committing fraud, the states will have some say into it. But generally, if we comply with B, we're good. And I did see a comment. My first kind of brought me to my first kind of major advanced strategy, and I saw that Hav brought it up. So as of about a year, in March of last year. So it's already March. A year ago, they passed a rule that actually allowed you to start doing a 506B in your deal and literally midstream pivot, meaning stop the 506B and then pivot and start doing a 506C under the same deal, which is actually a pretty amazing thing to do. There's some safeguards that we want to put in place, but in the old days, they wouldn't allow you to do that. They would just say, hey, you're just trying to combine these two exemptions, and we're going to consider these one deal, which is called, we would integrate these two offerings. But now they're actually allowing you to start 506B, fully comply with the rules. So as we mentioned before, no advertising, no general solicitation, but you can bring in your 35 non-accredited investors, get those investors in, and then at some point you can stop that offering. Technically, you stop 506B, you no longer take investors pursuant to that exemption, and then starting tomorrow, you open it up to 506C, which means you can start advertising your deal, but you would have to limit yourself to accredited investors only. And you must, of course, take reasonable steps to verify. But that's, I want to say it's a game changer, but it certainly is something that's very attractive for someone who, has a list, or maybe has investors, so that they have non-accredited people on the list. They want to take them in, but maybe they don't feel like they have enough in their current database to raise the entire amount. So they feel like they do have to go advertise a little bit, but they're kind of in that catch-22, which was the issue back in the day. Now you have this option of switching. It's technically two different offerings, and we do prepare two sets of documents, so they're very similar. They're substantially the same documents, but there are a couple of tweaks. Your business plan gets updated, so there's some extra work to be done, but it's just a great way of doing things. So that's kind of my first big sort of advanced strategy that nobody was talking about it until I started talking about it probably, I don't know, a couple months ago, and then I finally did a big presentation about it. It's funny, some of my friendly friends and competitors, their emails and phones got blown up by their clients saying, hey, what is this 506B to 506C? And a lot of them hadn't known about it. So you really have to do a deep dive into the rule. And I was actually shocked when I read it. I read it back in November of almost 2 years ago when I saw the proposed rule. But anyways, that's kind of a cool advanced stuff. The other thing I wanted to touch on is this issue of preferred returns, because I know that's something else, Ismael, we were talking about that. And preferred returns is different for everyone. And so everybody throws out this term preferred return. I've been meaning to make a sort of a more in-depth analysis of this, because everybody throws out this term preferred returns, but it has different meanings to different people. And so it's really, really important to make sure that you clearly define in your business plan and your PPM and all your offering documents, what exactly do you mean by preferred return? Because preferred return, first and foremost, is not a guarantee, right? A lot of people throw out preferred return and say, hey, you're going to get an 8% preferred, or a pref, as we call it. And people assume, well, that means I'm going to get 8% at least minimum. And that's not true at all. All a preferred return is that you as the investor will be getting 100% of any profits that we have to distribute, any distributions, you will get all of that money until you reach that 8% or whatever the pref is. And if there isn't enough money to give you an 8%, you may not get 8%. You might get them 6% or 3%, or if there's no distributions, you'll get 0. But it just gives you sort of that priority. So you're going to get 100% of that money until you hit that preferred return. And then above that, you split it a certain way. Some people, maybe they split it 80-20, maybe it's 50-50. That all depends on how you want to do it. But that's kind of the traditional way that I prefer. Like if somebody asked me what a preferred return, that's what I think of. But there's a lot of folks that have a little bit slightly different definition. There's probably 3 or 4 ones, but the other most common one I hear is they call it a preferred return, but it's really a sort of a floor more than anything. So same concept, 8% pref. Well, what happens, let's say it's an 8% pref and an 80-20 split after that. What essentially happens is they just split it 80-20 first. Forget about the pref for now. We do an 80-20 split and see what happens. And if the investors are less than 8%, then what happens is you'll throw some of your money over the fence until the investor gets their 8%. You're almost trying to not guarantee them, but you're trying to get them that 8%. As long as there's enough money to go around, you'll throw some money over their end to get to that 8%. Again, if there's not enough money to distribute, you can throw all of your money over, you still might be short. But the idea is that the sponsor will throw some of that extra money, not extra money, but their cut over the fence to make sure that that distribution at least hits that 80%. And then a lot of times they'll get credit for that. So if they threw over a couple bucks, then, hey, you owe me a couple bucks, which we'll eventually get at some point in the near future, whether it's at a refinance or a sale, or maybe next quarter, or however we want to define it. So, so preferred returns, my point there is just make sure you're crystal clear when you're communicating with your investors, and certainly when you're communicating with your attorney, make sure you're clear as to what your intent is with that preferred return, because it means different things to different people. One of the other things that pops up is the social media. So this kind of goes back into this advertising and generally soliciting. This is probably one of the biggest mistakes, for lack of a better word, or biggest issues that I see today is people using social media, which by the way includes your website or podcast or anything like that. People, for some reason, don't realize that is advertising. If you end up talking about your deal in one of those platforms, that's going to be considered generally soliciting or advertising. And if you're doing a 506B, remember one of the prohibitions, or the main prohibitions, you cannot advertise. So talking about your deal on social media is a big no-no under 506B, which I think most people get, although I have seen some kind of egregious examples of people flat out, posting about their deal and bragging that they're accepting non-accrediteds and it's a 506B. But I think most people understand that, look, I'm doing a 506B, I'm not allowed to talk about my deal. But one of the reasons that social media is a little bit tricky is because just like the definition of a security is really broad, as I talked about earlier, the definition of an offer, which is what really the SEC regulates, right? Offers and sales of securities, that's extremely broad and very nebulous, by the way. It's not a very black and white definition. And it includes everything we just talked about, meaning if I'm talking about or pitching a deal specifically, but it also includes what we call conditioning the market, whatever the hell that means. Conditioning the market meaning anything that you would post or talk about, which kind of gets people excited about your deal, whether you're talking specifically about the deal or not. that potentially could be considered an offer. So for example, if you start on social media, brag, even if, if you're bragging about the returns that you're getting your investors and you're telling them, hey, I get my investors 20, 30% returns, 50% returns, that's going to be something we call conditioning their market. Or, one of my favorite examples is, if you're at a due diligence trip, for example, and you're doing a video as you're walking the units and you make a video kind of not bragging, but talking about this new apartment complex that you acquired. You're not talking about a specific deal, but clearly there's investors involved and you're raising, you can tell by the way the video is being done. And even at the end, hey, if you're interested in learning more, reach out or click on this link. So there's a lot of ways that people can condition the market. And that's why I generally say that if you have an active deal, like Ismael, we have an active deal, don't just stay off of social media, right? I mean, post about your cats and your dogs and your kids, but don't get cute with real estate posts. But the time to use social media really is when you don't have a deal, in between deals, right? You're done with this one deal. That's when you want to be, actively looking for more investors. You always want to be looking for new investors and new relationships. That's the time to use social media. And the best advice I can give on social media, I think, is to use, which is not only just on syndications, but using value add to attract potential passive investors if you're a syndicator. So, for example, there's nothing that prevents you from putting a report together as to why real estate is the greatest asset class in the world and has created more millionaires and whatever, or why the state of Florida is the greatest real estate market right now and why it's so hot. And here are the 10 reasons why I think Florida is great. My example of the due diligence trip, a much better video on the due diligence trip would be like, hey, I'm here at this apartment. We're under contract. We're doing our walkthrough. Let me tell you my checklist. Here are the 5 things that I look for when I do a due diligence trip. On the outside, I look at the roof and blah, blah, blah. When I go inside, I look for washer and dryer hookups, or I look at this, whatever it is, but you're adding value to your investors. And if you somehow get, their contact information, maybe it's a report that you're putting together, or you're inviting them to an educational webinar or something, you can get their information, and then you start the process of getting to know them and establishing what we call a substantive relationship, so that when you get to know them, and now they're no longer strangers, and you get to know them, and now you can offer them a future deal. But using social media, first of all, it's very difficult to use social media if they don't know who you are. People I think that they're going to make a post on social media and suddenly they're going to raise $1 million. But it's a little bit longer process. But social media to me is more about adding value and getting into relationships, take them off of social media, go through the process of getting to know them. And then once you get to know them, then they're going to be eligible for future deal. So I think I'll take a breather there and see if there's any questions there, Ismael, about any of those topics. And then if not, I'm happy to keep going on some other sort of structural things.
We had some more questions on the conversion from a B to a C. One question is whether you have to know up front that you're going to pivot, or whether that's a decision you can make after you've gone down the road on a B, and all of a sudden you're like, man, I still need some money. What do I do? Let me do it then. I guess that's one question.
Yeah, so great question. The rule just came out back in March, so we have very little go off. Literally, we have the rule, which is 600 pages, but the rest of the best practices that we've kind of just developed on our own until we get some kind of guidance. Ideally, you do know ahead of time, because there's going to be some, the name of the game is always disclosure, right? So if you're going to suddenly start advertising, getting accredited investors in the future, we want to be able to disclose that to your future investors, your current investors. We actually prefer to structure it slightly different, just to be very clean. So when we do a B to a C, we actually create separate classes of shares or classes of membership units, so that it's very clear that when we start with the 506B, we're issuing, class A, for example. And then when we flip and we start marketing it, we're only marketing the other class B. So it's very clean as to, when they see an ad, it's very clear that we're doing the 506C, because we're only selling the shares that we were doing the 506C. So that's one example of the thing. Now you can do it. We have done it where somebody had no intention of doing a 506C or doing that. They wanted to do a 506B. And then, like you said, halfway through it, they're like, oh crap, I'm going to be short. I really would love to open it up. And we can do it. It's just messier, because one of the things that has happened is you've had what we call a material change. And so now the way you presented it to your investors ahead of time has now changed significantly, and enough where I would consider it a material change. And so what we would have to do is go back to all of those investors that came in originally and say, hey, look, guys, we've changed our mind. It's nothing illegal or anything, but we just decided to change our mind. It's a material change. So you have to give them the chance to get out of the deal if they don't like the change. So we do what we call a material change letter. We offer them basically a rescission right so they can get out if they want to. And if they don't, and there's like, yeah, no big deal, then they can sign the up, because now we'll have updated documents. So they'll sign the new documents and we can move them forward. It's much cleaner to do it ahead of time. I'd much rather do the opposite, which we've had a couple of clients do, where we'll start with the B2C and they just end up raising the whole thing under B. So they don't need to do the switch. So you can go either way. But yeah, great question. In my perfect role, we know ahead of time just because it's cleaner.
The other question I have is, and this may be, I guess it's like a lot of questions, it depends, but what's the typical cost for a pivot that is, known up front? Is there a change, or is there a difference between one or the other when you do the hybrid?
Yeah, I don't know how everybody else does it, but there's it's technically a second securities offering. We don't double the charge. Maybe I'd love to, but that's not realistic. There's a little bit of work. It's not a crazy amount of work. We just have an add-on. It's $5,000 extra to do the B2C, because number one, we do have to create, different classes of shares. We have to create, we like to create a resolution, sort of a corporate resolution, where we make a formal declaration, ideally notarized, where today's the day that we've terminated our offer under 506B, and we're no longer accepting. And by the way, when you terminate it, right? There's no stragglers. There's no money that was wired or on the way or a check in the mail. Like when you cut it off, you're not taking any more docs and you're not taking any more money. And so we do that corporate resolution, and then we flip it over to the C. And then when we do the C, there are a second set of documents. It's substantially the same, but there are some additional languages that we want to put in there. And then obviously just on the compliance side. So it does cost probably, 20 or 30% more, depending on what kind of deal you're doing, but not twice.
Then I have a question about I guess this is more nuanced. If you are not looking for passive investors, but you're looking for general partners or GPs or whatever the term that we want to use for folks, and you're putting that out in a closed mastermind group, is that something that is reasonable within the rules?
Yeah, I think, a co-GP to me is akin to a joint venture. So assuming it's a legitimate joint venture, really, where you're getting 3 or 4 general partners to get together, and now all 4 of those are actively involved, like a true spot, which obviously has to be for many different reasons. But if you're exclusively looking for GPs and it's not kind of a hidden, way to get more capital, then yeah, that wouldn't apply to you. It would be more of a joint venture rule. So this only applies, again, on a GP. Remember, all 4 or 5, or hopefully not that many, but 2, 3, or 4 GPs, they're all actively involved, so that the returns are generated by all of their efforts, right? So that's why it's not a securities, because you're not generating the return for the passive investor. You're the one generating the return for yourself. So as long as it's a legitimate co-sponsoring part, you could absolutely go on a mastermind and say, hey, look, I'm looking to partner with experienced operators or sponsors. Here's what I can bring to the table. I'm really good at ABC, and I'd love to partner with somebody. And if you're interested, let me know. That would be something that's totally fine.
And I have another question, and Candace, it's a little bit nuanced. So if you want to just kind of get on and just kind of ask it, because I'm not exactly sure if I quite understand it.
When you were just thank you. When you were just talking about separating the doing a B and a C, and then you were talking about dividing the investors by classes A and B, that's solely when you're actually doing an offer to an investor. Differences between the A and B class.
They're identical. Yeah, they're identical. Yeah, they don't have to. Yeah, they don't have to be. But usually, the way we've been doing it, they're literally identical. This is not a requirement of the rule. There's nothing in the rule that says you must create different classes. We've just developed sort of best practices that we think just make sense based on what we've read in the rule. And the one issue that potentially can come up when you're doing the B or the C is just the argument of you're kind of cross collateralizing, where you're doing a C, but you really use that C to bring somebody else into the B, which is why it's so critical to make a very clean cut, but then make it very clear that when you're on social media, you're advertising and you're doing 506C, that because you're saying, hey, I'm raising for class B, everybody's super clear that this is the 506C deal. It's not the B deal. There's nothing that requires that in the rule. It's just sort of best practice. And the way we've done it so far is that everything is exactly the same price for the shares, the same voting rights. Everything is identical, except that one class of shares was obtain via one exemption and the other one is the other. Now, you can, with a lot of funds or raises we do over time, you could change that. You could, for example, say probably the most popular I would think would be when we're doing a 506B, because we have non-accredited investors, we're going to make the minimum investment $50,000, for example. But then when we switch to 506C, we're going to up the minimum to 100,000 because that's what most accredited investors, expect. But you don't have to. Like I said, the ones that we've done so far, and we haven't done a ton, to be honest with you. People are just learning about it, and we've probably done 4 or 5 of these. They're all identical. The A shares and B shares, it makes no difference from the investor standpoint, which one they own, same price, same voting rights, same distribution, same everything. It's just a way to just make it crystal clear that we didn't mix those two. We want to make it, because it's got to be super clean, right? B until a certain time, and then C moving forward. If there's any overlap, that's where you get into trouble.
And just to touch a little bit more on that is, so when presenting the offer to an investor and you have it where you're going to do a B and a C, just so it's not confusing in the PPM, would you recommend just as if an investor comes on board, just to point out that they're probably going to see this in the PPM so that they don't get confused and want to know what's going on?
Sure. Yeah, no, 100%. In fact, we typically will see something even in the business plan. Now on the first one, on the 506B, you don't have to get into too much detail. You would just say, hey, look, we're planning. Not even planning. There's a chance that we may terminate this and start, we may advertise in the futures. That's why we've got these 2 classes, and we may do this. It doesn't mean we have to do this. So yes, always, whenever look, in general, I think you should warn your investors that the PPM is coming, because that's kind of a scary document, and you got to sort of let them know what it's for. But yeah, that would be very clearly delineated, even in the business plan. If you just read the business plan, you would know that this is a 506B with the potential to also be a 506C. So you definitely want to give the investors a heads up.
Mauricio, a completely different question here, at least a different angle here. Question is, can I invest with a 401k and an IRS? I'm assuming it's a self-directed IRA on the same deal.
Yeah, I mean, great question. Typically a 401k, you're going to be limited. I don't know of any custodian that's going to allow you to invest via 4. Now, if it's a solo 401k, that's a little bit different. So maybe that's what you're talking about, both the what we call either EQRP or a self-directed 401k. Then yes. Now there are some issues when you bring in as a sponsor. There's some issues because you really don't want to have more than 25% of your investors being IRA and 401ks if you have 401k people. This is a kind of a contested topic. If you just bring in a bunch of IRAs and nothing else, then you're going to be clean. From my perspective, I wouldn't even worry about the 25% rule. But if once you introduce a 401k person in there, now I would pay very much attention and not accept more than 25% of my monies from, IRAs, 401ks. But no, from a retirement account perspective, I'm not aware of any limitation. As long as obviously as an aggregate, you don't have, more than 50% ownership in the syndication, which I can't imagine how, that should be okay. And you can also introduce cash. I've got plenty of clients who will put some of that. Maybe the minimum is 100. I've seen it where 50 grand might come in from an IRA and then the 50 grand come in under personal name. So as long as your custodian's good with it and your sponsor is good with it, where you're not violating the 25% rule, then I'd be good with it.
And so a nuance to that is, if you are a co-GP, can you also use your self-directed IRA or a solo 401k?
Yeah, that's fine. Again, we just want to make sure that we're not violating that 50% rule. And if it's a husband and wife, it might be 25% rule, but it's possible if you've got a really small syndication and there's like 1 or 2 investors, that might be an issue. But if you've got a more traditional where you've got, 8, 9, 10, 20, 30 investors, that shouldn't be an issue. As long as we have this, just be aware that there's a 25% rule, which generally speaking, I think you should think the general rule is you should never take more than 25% from retirement account money. And if you get close to that, you should be discussing that with your attorney to make sure that you can go over that 25%. What else should we chat about?
I don't see any more questions on these subjects. So maybe we can touch a little bit on testing the waters. We talked about that a little bit, and it's just a terminology, but how you can actually, before you decide which way you're going, whether you can do a 506B or a C, sort of kind of throw some stuff out there before pre-PPM to see how much, essentially who bites, right? And so how do you do that? Is it legal, et cetera?
Oh, it's legal because there's at the same time they passed the rules on the 506B to 506C, they passed this rule 241. And they do allow you to, you actually are using the testing the waters usually is a Reg A, which is another exemption, which we didn't talk. It's probably the third most popular, which maybe 2% or 3% of the people use it. But testing the waters, theoretically, when you read it, it sounds exciting because it theoretically allows you to sort of, before you decide, what exemption, I don't know what exemption to go. I don't know what kind of, I'm trying to gauge interest from my audience. Let me post a couple things or put some information out there to kind of gauge interest on whether this is something that people would be interested in. And then once I get that feedback from the marketplace, then I'm like, okay, I'm going to do a B or C or whatever I'm going to do. There's a lot of it. I don't like it. There's a lot of issues about that. Number one is it involves intent, right? So how do you measure intent? How do you prove intent? So the rule assumes that you have not made a decision. You have to have an honest, where I don't know what exemption. Do I do a B, a C, a Reg A, a regulated crowdfunding? I'm not quite sure what the right exemption is for me. I really legitimately don't know. Let me make a couple of posts. The challenge is the two main challenges is that those posts are still considered general solicitation and advertising. So it really doesn't work with the 506B, which is what the vast majority of people are trying to do. They're trying to sort of get around the rule and they're like, well, let me post this thing. And then I'm like, I'm going to do a 506B. But it really is meant for all the exemptions that allow for advertising, which right now there's really three of them. So there's 506C, which we've talked about. There's a Reg A, which allows you to advertise. And then there's a regulated crowdfunding. There's also a relatively new exemption that also allows you to advertise. So if you're deciding between a C and a Reg A, for example, this would work. Or if you're thinking about doing a 506C or regulated crowdfunding, those kind of things could work. But otherwise, the challenge is, that they can be considered offers of, general solicitation, unless you specifically target accredited investors only or qualified purchasers, which is really institutional thing. So that's difficult to do it's impossible to do in social media unless you have a closed Facebook group. It would be more about, I think that would be more if you're doing a general mailing or something. If you knew all your people on your list were accredited, that might work. And then the other big one that makes it troubling is what we talked about earlier, which is it doesn't preempt the states. So even though you might be okay from the federal standpoint, if you end up getting an investor from the state of Florida, for example, and there's an issue, then the Florida Securities Board could have an issue with it because they don't necessarily have the same exemption. So all in all, it's kind of a little bit of a mess, to be honest with you. And I don't even know why, unless you're trying to get around and be sneaky, I don't know why you would legitimately want to use this unless you're considering between a Reg A and a 506C, for example. That would be probably the only thing I can think of. So I'm not a big fan of it, but again, that's just one man's opinion.
How I see your question, but I'm not exactly sure if I understand it. If you don't mind just jumping on the mic.
Yeah, my question. Good evening, everybody. My question was in the past, many times we need to close and we will get additional funds from different people, but they will not commit to have that money in their own run. And the reason why we had to do that is because we couldn't really market the deal to the open public. So from the legal standpoint, how do you change the paperwork? What are the consequences of doing those changes in the composition of the different investor base? We have done it, but I never really knew the details. So that's why I'm asking.
Yeah, great question. And I don't know if this is exactly the same. It's a material change. So we talked about a material change letter. That would be the proper mechanism where it comes up, and maybe it's similar to what you're talking about. The way it comes up, not a lot, but it comes up every so often in our world, is when, like you said, you're about to close, you're a week away from close and you're short, right? And you're like, crap, I need another 200,000, I need another 100,000. And I don't know if I don't have it and I got to close in a week. And if I don't close, then not only do I lose the property, I lose my earnest money deposit, and it's not a good situation. And so it's not, in those situations, you're scrambling, right? And so now you're bringing in, hard money lenders to help you out, or the worst one, which is, it's a reality, is people bring in private equity money, which is just brutal, because they'll just, they're in such a strong negotiating position that they'll just take everything from you basically, but you're so desperate because you don't want to lose your earnest money deposit. So in those examples where you're trying to bring in something brand new, so for example, if you're trying to bring in a short-term lender in, maybe it's a hard money loan, maybe it's just even your buddy that's got 200 grand, you're going to pay him 20% for the money for a week. That was never disclosed on the front end, right? And so, and when you bring a private equity group, you're usually completely changing the structure. Now they're becoming a different class, or maybe there's a joint venture arrangement, the whole structure changes. So whenever that happens, there is a solution. The solution just is you have to notify the investors that you're switching, you're pivoting, you're adding something, you're bringing in an extra lender that you didn't talk about, or a private equity group, or a short-term bridge loan, or what have you. And so you have to let the investors know, and they have to be okay with it, meaning they've got to approve and say, look, even though I understand, first of all, you're going to disclose all the additional risks, if any, pursuant to this new arrangement, and then the investor gets to choose whether they want to stay in or not. And so that also creates a lot of issues, because if you're 1 week from closing and there's already some problems, you may have some investors that get cold feet and want to bail, and you want to make sure that that material letter goes out, because what happens if you don't give them that, not only if you don't give them that material change letter, but if you don't make it crystal clear that they had the option to get out, and you just like, oh, we got a material change, please sign here. Then what happens in the future, if something goes wrong, then the investor will use that against you and say, look, if I'd known that you were going to bring in this person here, I wouldn't have invested, and you didn't disclose that information to me, and therefore, you're in violation. And so the penalty for violations is going to be rescission. So give me my money back, even though, maybe you didn't do, theoretically, you may not have done anything wrong, but if something in the future goes wrong and you haven't followed all those securities laws, then the penalty for you is going to be rescission, meaning you're going to give the investors their money back. So the proper mechanism to sort of wrap it up and make it a more direct answer is just, you have to go up with a material change letter to all of your investors and give them a chance to get out.
Candace, go ahead. I know you got a good one.
Okay, thanks. So coming in as an entity on a GP position, bringing in my entity on the investor capital raising portion of the GP, obviously I can't just be a part of the GP without having other responsibilities. So in my operating agreement of my entity, is asset management vague enough to put, or do I need to be more specific as to investor relations, capital raising, describing what type of asset management, or just saying asset management is enough to be in my operating agreement of my personal entity?
Yeah, that's a great question. Asset management is great. Actually, that's what they really focus on. They want to make sure you're doing something after you're done with the raise. But it actually doesn't even matter so much what's in the documents. But so to the extent you're going to put something, which you should, asset management would be just fine. The challenge is, it doesn't matter what you put in the documents. What matters is what you can prove if something were to go wrong, right? So if something were to go wrong, and they're going to be looking back and say, well, hey, what did you do? Oh, I did asset management. Okay, well, what kind of asset management? And then now you're going to have to prove that you did asset management. And where you're really getting at is you're going to have to prove that you were involved in what we call substantial duties, right? That's the key term in all of this, is that you've got to be legitimately involved in the deal, not just raising money, not just maybe just being kind of a small time investor relations. Did you engage in substantial duties? And yes, it does help for you to outline what those substantial duties were. But at the end of the day, you're going to have to show, if you're the asset manager and you were the boots on the ground, or if you were involved in due diligence or whatever, then you're going to have to bust out, airline tickets and hotels and meals. Like, you've got to show and prove, it's your burden to prove that you did in fact attend these meetings, that you did go down and do the asset management, you did meet with the property manager, you did do, if you did investor relations, what type was it? Was it just forwarding emails, or were you legitimately, taking inquiries from investors and solving their problems and putting the reports together and figuring out the distributions? I mean, it's going to be your burden to prove that. So yes, it's important to put something in it's probably good practice to put something in the operating room, but ultimately it's what you can prove, not just what you can say.
Would an app like Telegram be enough to support that interaction in between team members?
I'm not familiar. Is that kind of a Slack thing?
Somewhat, yeah.
if you're trying to show interaction between the team members, yeah, that would obviously be helpful. Yes. I mean, anything that you can document. So for example, I'll give you another good example. A lot of people say, yeah, well, we're part of the, I'm part of the team that meets with the whatever their once a week meeting or how often they meet with the property manager. And I always say, well, that's great that they're meeting, but are they actually contributing? Like, are you actually, adding value to the meeting? Or are you just showing up on Zoom and maybe you're not even there, or you show up half the time? Like, you've got to document, whether that's minutes of meetings where you can see that, hey, I'm actually participating and I'm giving you my thoughts and here's what I think we should do, and really being part of the conversation. Or are you just like a passive attendant that just sits there at the meeting, or maybe doesn't even show up to the meeting? So whatever, there's no magic, whether it's the software, the app, whatever you can show that really shows that you were actively involved and you were, again, involved in those substantial duties will suffice. It's just your burden to prove it. But that sounds like if there's an app that shows all the back and forth and you can clearly see that, hey, there was a decision to be made and somebody wanted to do one thing and Candace was very adamant over here, no, we should do something else. And maybe at the end, Candace lost out and they went the different direction. It doesn't matter. You can show that you were actively, making your point and trying to convince that you thought it was going to go one way and you got outvoted. That's fine.
Mauricio, I think we got about maybe 10 minutes. Is that good for you? Or
that's good. You want to talk about the accredited investor stuff, or?
Yeah, definitely the accreditor and investor stuff, and maybe touch base on the fund of funds. I don't think that's come up at all.
The fund of funds is like a 6-hour presentation. So fund of funds. Fund of funds is a term that applies when you're raising capital into your own fund, into your own LLC, with the intent of investing in somebody else's deal. So it's somebody else has Ismael has a fund. He's raising $10 million. I go out there, I raise money into Mauricio's fund. And then I turn around and say, hey, look, Ismael's deal is pretty good. I'm going to allocate $1 million of my fund to Ismael's fund. And now I'm basically a limited partner in that fund. That's why I call it a fund of funds. I used to call it a sort of a sub syndication almost, because it's kind of a small part. Some people call it a feeder fund or whatever, but fund of funds that's generally the thing. And there's a lot of additional complexities when that happens. And so there's really, I think there's 4 of them. I'll see if I can remember all 4 of them. So the first thing, the most important thing you've got to keep in mind when you are putting together a syndication to go invest in somebody else's deal is that you're actually investing in a security now. You're no longer investing in real estate. You're investing in shares in somebody else's company. They're going to be membership units, but essentially you're buying stock, just like you're buying Apple stock or somebody else stock, which means you're in the business of advising your LLC as to the purchase of securities, which makes you an investment advisor. So the first thing to remember is that you've got to worry about the investment. In addition to the 506B, 506C, that's the main thing. But the investment advisory rules is the next issue you've got to think about. And for most of us, unless you've got, I think it's $100 million in assets under management, it's not going to be, you're going to be prohibited actually from even registering at the federal level. So this is going to be a state by state issue. So you have to look at your particular state. So the question is, do I need to register as an investment advisor in my state, or is there an exemption to that registration, right? And every state I've seen except one, actually 2, but then one changed their rules and got an exemption, has some sort of an exemption where you don't have to actually go register as an investment advisor, but they can vary from like very little compliance, meaning, look, as long as you're doing less than 15 of these syndications, we're good. Like like Pennsylvania doesn't really care. All the way to moderate, like Texas and California, where, yeah, you can do this. You don't have to register, but you're going to be limited to accredited investors only in your fund, because that puts some limitations on it. All the way to sort of the extreme, which is like there's some states like the state of Massachusetts, which says, yeah, it's accredited only, but you've got to have $2 million in net worth as opposed to $1 million. Or the state of Washington, which I think is the most egregious one I've seen. The state of Washington says you can only take qualified individuals, which is you must have the individual, your investors would have to have $5 million in investable assets to be eligible for your fund. So it just depends on the state. So you just have to ask your attorney what state, and it's where you're physically located, because the way the rules work is the law sees you advising your LLC. That's the advising. So that happens when you're sitting in your office or your home office or whatever. So whatever state that's in, we want to take a look at the investment advisory rules. The other point, which I guess was point number 1, is that the same compliance rules apply to fund of funds and anything else. Is it still register the security, find an exemption, or it's illegal? The third thing you got to worry about is, because you're a passive investor, your fund is passive. We want to make sure we avoid the investment. We don't want to be an investment company. So we want to avoid the Investment Companies Act of 1940, because if I'm categorized as an investment company, then all hell breaks loose and there's all kinds of regulation that I want to do. So I want to avoid at all costs being categorized as an investment company and therefore having to register under the Investment Companies Act. And the easiest way to do that, the most common way to do that, is to have less than 100 investors in your deal. I would try not to get anywhere close to 100 because there's ways of calculating that might screw you up. So, the co-sponsors might be, and they may have entities that have members. So if you're getting anywhere close to that 80, 85, start ringing the alarm and talking to your securities attorney. But that would make you what we call a 3C1, a company, which is less than 100 investors. And that would make you, that's the easiest exemption to the Investment Companies Act. And then the last thing that you want to worry about is the broker-dealer laws, because we haven't talked about it, but the general rule is you cannot raise money for other people, right, without being a broker-dealer. So the last thing I want to make it look like is that Mauricio is basically just raising a bunch of money to give it to Ismael, and I'm getting compensated to do that. And so we're always very cognizant of what I would call a disguised commission, right? I want to make sure that it doesn't look like I just put together a bunch of entities and, these complicated structures and smoke and mirrors, when at the end of the day, Ismael's paying my fund more money. That money ends up in my pocket somehow through fees, and essentially just it's Ismael paying me a commission. So those are probably the four things that I would be concerned about. The one thing this has been recent, but you've got to justify, again, trying to avoid the broker-dealer laws and being considered a money raiser. You've got to justify your fees, right? So you're going to charge your fund the same fees as everything, an acquisition fee, an 80-20 split, however you're going to structure it, that's fine. But what are you getting compensated for? Right. And so generally you're getting compensated for the due diligence, right, on the sponsor, right? Because your investors are passive. They don't have time to go meet with Ismael, fly down to Florida, meet with them and his team and operations. They don't have, then when Ismael has a deal, they don't have time to get on a plane and go walk the units and all. So that's, you're adding value to your investors that way. The other way you're adding value to your investors is that you're typically negotiating better deal, right? If Ismael's is raising $4 million and I pick up the phone and say, I got $1 million to put in your deal, but I've got some additional requests, Ismael's going to listen to me, and maybe I get a better discount, maybe discounts his fees, or maybe I get, if it's a 70-30 deal, so he's paying his investors 70%, maybe I get 75 or 80%, because again, I'm bringing a large chunk of dough, especially if it's late in the process. So that's another way you can add value to your investors. Another way you can add value to investors is the minimum investment. Maybe Ismael's is a phenomenal deal, but his minimum is 100 grand or 200 grand. And my investors, my minimum is 25 grand. So, my investors couldn't really even access Ismael's deal because it's the minimum threshold is too high. But through my LLC, through my vehicle, my single purpose vehicle, they can get access to those deals. So you're trying to do all these things to justify your fee. Otherwise, if you're just basically raising money into your fund, turning around and writing a check to somebody else, and then you're getting paid for that, that's just going to be raising money for somebody else.
You're right. That is a long one. So I appreciate you.
I did that in like 4 minutes. I was like, that could be a 3-day seminar in and of itself.
Absolutely. So yeah, I guess we can finish up with that, with the potential change to the to accredited rule there. That I think will impact more people than we'd like, actually.
I read a post on, if you guys aren't on LinkedIn, I highly recommend everybody to be on LinkedIn, and feel free to reach out to me there. But I did a post the other day. There's a bunch of, if you just Google accredited investor these days, there's a bunch of articles out there, and they all tie to the same source, which is a Bloomberg article that claims that the SEC is thinking about raising the threshold of accredited investors up to $10 million. So right now it's $1 million in net worth, excluding your primary residence. The internet, the Google says 10 million. I couldn't find that. I actually went through the source. I didn't see the 10 million. I saw some reference to, offerings up to 10 million. Because I've been following this closely, and I was actually listening into, the actual meetings and stuff, and I've never seen that number, but I do know that it's on the schedule for March to discuss, and not to increase, but just kind of redefine that. So here's my thinking on this. There's already an update from a year and a half ago, approximately, where they're trying to expand the definition of accredited investor, right? So right now it's purely on the base of income and net worth. There's a lot of arguments as to whether that's something that makes sense. We all know people who are extremely bright and don't have much money. And we also know that people with a lot of money sometimes are the dumbest people in the room. So there's always been this debate whether net worth or income should be the right mechanism. And so they came up with this rule and said, look, we're going to allow people to certify, meaning take a course pass an exam essentially, and then become certified as an accredited investor. So that way, if you don't have the means, but you've got the, the sophistication and you studied, and then that's the direction that we're going. When the rule passed, they only allowed investment advisors to fit that category. So as of today, if you're a registered investment advisor with the SEC, or you have a Series 82, or Series 7, Series 65 in good standing with your state, you're an accredited investor, even though you don't have the financial qualifications. And then the rule says, as we go on, we'll be releasing some certification programs where you can actually, again, go take a course. We don't know if it's a weekend, self-study, semester, like we don't know what that looks like. And then you're going to take an exam and they're going to certify you. That still hasn't happened, right? And they're starting to talk about it again. Like I said, in April, they actually had a meeting last month, and in April, they're going to come out with a proposed rule, which I frankly don't understand why, because they already came out with a proposed rule and they said they were going to do this. Now I'm just waiting for the certification programs to come in. But this article got me thinking that what makes sense to me is that the $1 million number is from 1982. So it's been a while since they've updated. And if you and again, this is not confirmed, I just Googled it, but apparently $1 million in 1982 is about 2.8 or 2.9 million today, right? So even if you just adjusted it for the official CPI inflation rate, accredited investors now should be about $2 to $3 million. And it makes sense to me that if they're going to expand the definition, allow people who are not accredited to be able to become accredited via a certification program, it makes sense to me that they would also increase the limits. So that, hey, we're going to increase the limits, but that doesn't mean that you're out of the picture. It just means more people are going to be forced to go take the certification route and take an exam and actually study and become sophisticated officially, than just being automatically qualified through net worth requirements. So even if they went 10 million, which I don't think they will, that doesn't mean that, hey, I've got a $5 million net worth. I used to be accredited, now I'm not. Yeah, but you can go take an exam and get certified, and it really shouldn't be a huge, it's a little bit of an inconvenience, I guess, because you got to take the exam. But to me, that doesn't sound like the end of the world. My guess is they're going to adjust it for inflation. And so they are going to increase it, I think. We'll see in April. But I think it'll be closer to sort of 2.5 or 3 million or something, maybe 5 or something. But again, if you're in that category where you used to be accredited, now you're not, that just means you're going to have to go take an exam to become accredited as opposed to just automatically qualify. So but I didn't see anything in the actual Bloomberg article that specifically said the 10 million, but I did see, this is what I noticed, that it is on the regulatory agenda for the next 6 months. So there's a couple of other rules that we're following that we were looking for updates, and that's not on the agenda. The accredited investor thing is on the agenda. They had a meeting back in February, and I know it's on the agenda for them to come out with a proposed rule next month. And so we'll just see what the proposed rule says. And the proposed rule is just a proposed rule. After that, they have a comment period, and they'll get some feedback, and then eventually they'll come out with a final rule, maybe 3 or 4 quarters down the line.
Okay, so we don't have to run in and get our accredited investors now and risk.
No, it's going to take forever. I mean, let's assume that in April they come out, which they will, with the rule, and the rule does say something crazy. Then there's a 30-day comment period. Then it takes them at least a couple of quarters to come out with the final rule. And then there's another 60 days before it becomes published in the Federal Register. I mean, it's usually a year between the time the idea comes out. And it wouldn't be uncommon for them to come out and say, hey, it's going to be 5 million, get all this pushback. And then okay, we've read all the comments, we get it. We're going to do 2.5 or maybe 0. Who knows? We don't know what it's going to look like. I got questions about whether you're going to be grandfathered in. Maybe you get grandfathered in. Who knows? We don't know because we haven't seen the proposed rule yet.
Right. Well, we took all of your time, Mauricio. I really.
Oh, that's my pleasure. No, absolutely. If you got any straggling questions, I'm happy to answer 1 or 2 here. I want to make sure we get to everyone's questions.
All right. Well, there you go. 5 minutes, I guess. Anybody else?
I'll just make another. If I didn't answer or you come up with another question, Ismael, if you don't mind, the YouTube channel, I'm trying to post as many stuff on that. It's super educational. I put a lot of content on YouTube. So if you found any value in this, I'd love for you guys to go to Mauricio Rauld, and there's a bunch of videos out there, and we'd obviously love a subscribe if you found any of the stuff valuable.
Okay. So they just basically search for your name.
Just search my name. There's not too many Mauricio Raulds out there.
Yeah, absolutely. I encourage it, and we'll put it out when we're going to record this. I am recording it. And
cool.
Then
Yeah.
we'll
Perfect.
post it on my YouTube, and then I'll put a link to yours as well.
Perfect.
That'd be great.
Perfect. Yeah.
Excellent. So I guess at this point, I just want to touch base that our next meeting is next month, Monday, the 3rd Monday of the month, April 18th at 8 p.m. Eastern. and we're going to deep dive into real estate syndication teams. Not just who the teams are, what they consist of, but what makes some teams more successful than others. And again, this is a perspective, but I think it'd be good for not just active investors or sponsors to listen in, but also for passive investors that are getting different deals and they're wondering, okay, why this one versus that one, and how you can kind of use that other piece of analysis to determine which way you want to go. So I think it's important that you do have the yin and yangs within your team, and then we'll go into that some more. But at this point, I don't want to take any more of your time, Mauricio. Thanks again very much. I tell the whole group, and I'll tell you, remember where it makes sense to invest, and that's where we want to go.